All right, today we're tearing down the Q3 earnings report for ServisFirst Bank shares. And let me tell you, this was a messy one. But it's the story behind the headline numbers and the market's pretty dramatic reaction that really makes this worth talking about. So here's how we're going to break it all down. First, we'll look at the market's knee-jerk reaction. What happened the second those numbers came out? Then we'll dig into management's side of the story. After that, we have to talk about the big red flag in the report, this new credit concern. We'll figure out why Wall Street got so spooked, and then we'll wrap it up by looking ahead to what's next for the stock. Okay, first things first. Let's look at the market's immediate verdict, because honestly, it sets the stage for everything else we're about to unpack. Right out of the gate, as soon as the numbers hit the wire, the stock took about a 5% dive in after-hours trading. That is a loud and clear signal that investors were not happy. So the question is, what went wrong? And yep, here's your answer. This slide lays it out perfectly. ServisFirst missed on earnings, and they missed on revenue. You know, in a market that's rewarding companies that beat expectations, a double miss like this, well, it's pretty much a guaranteed recipe for a sell-off. But here's where it gets interesting. Despite that smackdown from the market, if you listen to the earnings call, management painted a totally different picture. They were all about the fundamental strength of the bank and the smart, strategic moves they're making. Management's first big counter-argument was this number right here, a 13.3% growth in book value per share. For a bank, that's a huge deal. It's a core measure of how much real value they're creating for shareholders, and frankly, that's a very, very strong number. And they didn't stop there. They also pointed to their core profitability, a 16.2% adjusted return on equity. I mean, that's top-tier stuff. It puts them in the upper echelon of their peers and tells you that their basic business of banking is an absolute moneymaker. Now this is absolutely crucial. Even in this tough environment for banks, ServisFirst actually expanded its net interest margin, that's the profit it makes on its loans, by 0.25 percentage point over the last year. Trust me, management made sure to hammer this point home on the call. So you might be asking, how are they pulling that off? Well, here's a key piece of the puzzle. They're actively repositioning their bond portfolio. They sold off over $83 million of old bonds that were yielding a measly 1.66%. Now, yeah, they had to take an almost $8 million loss to do it, but here's the brilliant part. They immediately took that cash and plowed it into new bonds yielding over 6%. It's a classic case of taking some short-term pain from much bigger long-term gain. All right, time to talk about the elephant in the room, because besides the earnings miss, this was the single biggest reason the stock got punished. A sudden, really sharp spike in what are called non-performing assets. And for any bank, that is a major, major red flag. Wow. I mean, this chart just says it all, doesn't it? The ratio of bad loans to total assets more than doubled in just one quarter. It jumped all the way from 0.42% to nearly a full percent. A move like that is guaranteed to set off alarm bells all over Wall Street. Management, of course, was ready for this question. They were quick to try and put out the fire. Their chief credit officer, Jim Harper, basically said, "Whoa, hold on. This entire spike, it's all tied to one single borrower." And he made sure to add that they've already moved in and secured more collateral to protect themselves. The way they framed this was really interesting too. They called it credit normalization. The argument is basically, hey, for the last few years, we've had freakishly low levels of bad loans, and now things are just getting back to, well, normal. But the billion-dollar question for investors is this just one isolated problem, or is this the canary in the coal mine? So this brings us right back to where we started. If management is so confident about their core business, why did the market freak out? This slide really shows the massive disconnect. You've got two completely different stories being told at the same time. Management is talking about their fantastic profitability, their balance sheet, their smart strategic moves. But the market? All the market heard was, you missed earnings, loan growth is slowing down, and oh, by the way, you might have a new credit problem. And you have to remember the context here. Going into this report, some people were actually expecting a beat. On top of that, the stock had already been underperforming its peers, and the entire regional banking sector is nervous right now. So when you throw a miss and a credit scare into that kind of environment, well, it was just too much for the market to stomach. So let's put a bow on all of this and look to the future. What does this all mean for the stock, and what are we going to be watching for on the next earnings call? Okay, so what's the path forward for the stock to get its mojo back? It's pretty simple, actually. It's a show-me story. First, they have to hit their next earnings target, period. No excuses. Second, they have to prove, without a doubt, that this credit issue was a one-time thing and it's contained. And third, they need to keep showing that their core profit engine, that margin expansion, is still firing on all cylinders. So, with all that said, our reading on the stock is market perform. The bank's core profitability is undeniably strong. You can't take that away from them. But those positives are pretty much perfectly balanced out by the new risks around credit and slower growth. For now, it's a wait and see. And that really leaves us with the one single question that's going to define this stock for the next year. Can management's fantastic execution on the core business convince the market to look past this new, dark cloud of credit uncertainty? The answer to that question is going to come in the next earnings report. And as always, a final and important reminder, this is not financial advice.